Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we have three major stories for you. First up, a bombshell lawsuit from a Federal Reserve governor against the president, all happening as markets bet on an 89% chance of a rate cut. Then we'll look at how a single rule change pushed luxury retailer SSENSE, once valued at $4 billion, into a bankruptcy showdown with its own lenders. And finally, the paradox of Alibaba, where a brutal price war is crushing profits, even as its AI cloud division is surging by an incredible 26%. A sitting Federal Reserve governor is now suing the President of the United States to keep her job. This bombshell lawsuit is the backdrop for a high-stakes showdown that could dictate the direction of your money. The controversy has ignited concerns over the Fed's independence, its very ability to make decisions without political pressure. The Federal Reserve's independence isn't just some abstract concept. It's the bedrock of a stable economy. When political leaders interfere with a central bank, history shows us the results can be catastrophic. We've seen it in countries like Turkey and Argentina, where political pressure to keep interest rates artificially low led to runaway inflation and economic turmoil. So this isn't just a political drama. It's a fight to protect the US economy from that kind of instability. And it's all coming to a head as Wall Street holds its breath for one critical piece of data, the August jobs report. What's really interesting here, though, is that in an economy increasingly driven by artificial intelligence, there's a growing debate about whether these traditional monthly reports are becoming obsolete. They are what we call lagging indicators. They tell us where the economy was, not where it is right now. Some experts argue the Fed should be looking at high-frequency data to make faster decisions. But for now, the market remains fixated on this one number. Last month's report was a shocker, adding a surprisingly weak 73,000 jobs, which sent expectations for a rate cut soaring. Right now, the market is pricing in an 89% chance the Fed will be forced to cut interest rates. Investors have shaken off recession fears, pushing the S&P 500 up nearly 10% for the year. It's a strange paradox that has Wall Street completely hooked. Research from the National Bureau of Economic Research actually confirms this bizarre behavior. During economic expansions, bad news is often seen as good news for stocks because traders bet it will force the Fed to cut interest rates, juicing the market. The system has become dependent on the Fed's intervention, not genuine economic strength. This all boils down to the upcoming jobs number. A strong report could shatter the rate cut narrative, while a weak one could confirm a slowdown is here, raising entirely different fears. And here's a crucial layer to this story: a disconnect between the stock market and the real economy. This rally isn't broad-based. It's been powered by a handful of giant tech companies pouring billions into AI. The catch? Research from MIT shows a staggering 95% of these corporate AI projects fail to deliver any return on investment. At the same time, the top 10% of US households own nearly 90% of all stocks. So while Wall Street celebrates, many on Main Street aren't feeling the benefits. On top of all this, we are now entering September, which for the last 35 years has been the single worst performing month for the stock market. It's the only month that has historically been down more often than up. The stage is set. A political battle at the Fed, a market at record highs, banking on bad news, and a historically treacherous month dead ahead. The question is, which one breaks first? Speaking of treacherous conditions, it's not just market cycles that can sink a company. Sometimes it's a single stroke of a pen in Washington, which brings us to our next story, a luxury fashion giant in a showdown with its own lenders. SSENSE has filed for bankruptcy protection to stop a forced sale of the company. What pushed them over the edge? A single US policy change that just blindsided the retail world. The policy is the Minimis exemption, a rule that for decades allowed packages under $800 to enter the US completely duty-free. Last year alone, that accounted for 1.4 billion packages, worth a staggering $64 billion. This wasn't just a loophole, it was the engine for a huge part of global e-commerce. In the last fiscal year, an incredible 73% of those duty-free packages came from one country, China. This allowed companies like Shein, Temu, and Sensi to ship directly to US consumers, bypassing tariffs American stores have to pay. But that door just slammed shut, and the fallout was immediate and global. Believe it or not, we're talking about major postal services in over 30 countries, including the UK, Japan, and Germany, temporarily halting all shipments to the US as they scrambled to figure out the new rules. In an email to staff, the CEO of Canadian retailer SSENSE said his company was surprised by the rule change, saying it created an immediate liquidity crisis no short-term fix could solve. But this is where the situation takes a more complex turn. SSENSE's SSENSE claimed its primary lender tried to force a sale of the company without their consent. Now, this kind of aggressive move by a lender suggests a huge shift in confidence. Instead of working on a restructuring plan, creditors seem to have decided it was better to liquidate the assets immediately, signaling a growing fear about the stability of these online-only retail models. In response, the retailer filed for creditor protection to retain control of our assets and operations and defend our future. And this isn't some small boutique. In 2021, venture capital firm Sequoia valued SSENSE at $4 billion. Now, it's fighting for its life. This whole situation really exposes a massive blind spot in how even the smartest investors value companies. That $4 billion valuation didn't properly account for the political risk that a single rule change could cripple the entire business model. The fallout is already spreading. Tapestry, the parent company of Coach, is bracing for a $160 million hit to its profits, attributing a third of that directly to this policy change. And the flip side for you, the consumer, while the policy change was meant to protect US businesses, it also means you'll likely face higher prices and have fewer choices. One study from the Federal Reserve Bank of Atlanta estimated these kinds of tariffs could raise consumer prices by up to 1.6%. One expert called it a double whammy for retail and warned there is more to come. It all begs the question, as trade rules shift overnight, how many other billion-dollar companies are just one executive order away from a similar crisis? That question of how quickly a billion-dollar company can find itself in crisis brings us right to Alibaba, which just delivered a very confusing report to the market. Alibaba just missed its big revenue target, sending shockwaves through the market. But here's the twist. The stock actually ticked up. So what is actually going on inside one of the world's biggest tech giants? While everyone was watching its famous e-commerce sites, a different part of the company was exploding. Alibaba's cloud business, powered by a massive push into AI, saw its revenue surge an incredible 26%. That didn't just beat expectations, it crushed them. This surge wasn't just magic, it was a calculated, aggressive move. Alibaba is in the middle of a fierce price war for the AI cloud market. They've been slashing the prices for their main AI model, with some rates cut by as much as 97%, a clear signal. They're prioritizing market share over immediate profits, hoping to hook customers into their ecosystem for the long haul. The company's CEO, Eddie Wu, confirmed that AI-related products are now a significant driver of revenue. This is the silver lining. However, if you zoom out, you'll see another layer of strategy at play. To understand the full picture, you have to look at the battlefield. Alibaba's core business is locked in a brutal, subsidy-driven war over instant commerce. Instant commerce is the race to deliver everything from groceries to electronics to your door in under an hour. It's a fight for the future of retail, and the prize is enormous, a market projected to be worth over 2 trillion yuan by 2030. That's why everyone is willing to burn so much cash to win. This fight is so intense, it caused the company's adjusted earnings to fall 14%. And this isn't just an Alibaba story, it's an industry-wide bloodbath. Its rival, PDD, saw its operating income drop 21%. And food delivery giant Meituan, get this, it reported a staggering 97% dive in net income, even as its revenue was growing. That just shows how deeply these subsidy wars are cutting into the bottom line. So, is Alibaba sacrificing today's e-commerce profits to win a scorched earth war, all while its AI-fueled cloud division quietly builds a new empire? Interestingly enough, that new empire is being built with a unique advantage. It's not just about cheap cloud services, it's about creating AI models specifically tailored for the linguistic and cultural nuances of the Chinese market, a strategy that could create a powerful, long-term competitive moat. As always, remember that markets are volatile, and this report is for informational purposes only, not investment advice. The figures are changing in real time as investors try to decide which version of Alibaba is the real one.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.